Hello and welcome to another video on how to secure yourself financially. So in today's video, I'm going to look at the financial statements, ratios and calculations. So over the couple months, I dedicated time to read and understand this beginner guide to financial statement provided by the SEC, the Security Exchange Commission, where they mention that if you're able to read nutritional labels or follow or read baseball box score, you can learn to read the basic part of financial statement, and you can follow up, or if you know uh, how to follow a recipe, or you know how to apply for a loan, you can learn the basic of accounting. And the basic, they're difficult. So after all, financial statement, they show you the money. And there are four types of them. You have balance sheet, income statement, cash flow, and statement of the shareholders. So the first balance sheet shows the company, or it is a snapshot of the company assets, liabilities, and shareholders' equity over a period of time. So the income statement show you is how much money a company made and spent on producing good and service. So ultimately, the bottom line of this statement shows if a company made a profit or not. And in the cash flow, what it does is report the company inflow and outflow of cash by reusing the information from the balance sheets and the income statement. Okay, the cash flow review the cash flow from one of these activities: operations, investing, and financing. And at the bottom line of the statement, it shows you the net increase or decrease in cash. So when we talk about the operating activities, most of the time it can be broken down into common operating assets and liabilities. Where on the common operating assets, we have things like property, plant, and equipment, accounts receivables, inventory, prepay expense, such as premium insurance like home, vehicle, health, liabilities, disability, as well as long-term care, rent, marketing, office supplies, software license, and maintaining contracts are another example of this prepay expense. Also, I look at investment in affiliates, which is when a company purchases significant amount of stake in the another company, raising its voice or its influence in the another company management decision without taking full control of them. So things like joint ventures, such as Post Malone and Crocs, where each one of those partners involved in the joint ventures receive a share from the project. Equity investment, where now these are companies that invest on another company, aka holding companies. So here, the equity investment, or most common equity investment, we have Berkshire Hathaway, Alphabet, SoftBank, Texas Pacific Groups, associates, and limited partnerships are another example of this investment in affiliates. And when it comes to intangible assets, right? Things like patents, copyrights, trademarks, goodwill, trade secrets are another example of that. So, okay, with that, then I also look at common operating assets like cash and cash equivalents, such as money market funds, for example, they allow you to park money momentarily or for a brief period of time until you decide where you want to invest that money. Okay, so in the common operating liabilities, we have things like accounts payable, accrue expense like rent, utility bills, administering salaries, income taxes, also defer revenue, so obligations that a company has to provide for good and service over a period of time based on money that was collected, such as subscription service or gift cards. Another example of common operating liabilities here is short-term borrowings or notes payable, as well as warranty obligations. So the operating activity here, where the focus is on that, okay, and it analyzes the net income from the income statement and conciliate with the total amount of cash that was used or perceived from one of these activities that I mentioned before. Okay, and the way to do that it adjusts the net income for any non-cash items that affect the state or the income statement where there is no cash involved. So, for example, stock-based compensations or amortization or depreciation. Okay. Also, things like adjust any cash that was used or perceived for other operating assets and liabilities. Okay. And when it comes to the investing activity, generally, it involves the purchase or sale of long-term assets, such as property, plant, and equipment, investment, intangible assets, leasehold improvement. And in the financing activity, we saw that this section focused on how a company is raising funds to pay it back to investors through capital markets. And it's very helpful for investors to see how often a company is raising funds and where this money came from. Because if a company is constantly taking out of debt or issuing equity, that might not be a good sign of investment, allegedly. However, if the cash flow from a company comes primarily from its operations, that might be a good sign of investment. Again, the devil is on the detail. But the activity involved in the financing aspect, which is the third part of the cash flow statement. Okay, these financing activities focus on issuing equity, issuing debt, repaying debt, repurchasing stocks, as well as leasing, okay, which is the right a company has to give to another company to use some property, plant, equipment, buildings, to use that without taking ownership of that. So this is a lot of this Aikido stuff that you see in the financial aspect. I'm gonna lease you this, okay? But you won't be able to own that, which is something that I see that will be that's how things will be, you know. That's how things will be. That's definitely how things will be in this modern era. So you wouldn't own anything. You will anyone, a bigger company, most of the time will give you a leasing, a right to use without taking ownership. And that is something pretty fucked up, you know? And that, my friend, is something pretty fucked up. Because it's like, uh, you'll have, so this will force you to work until you die, which is not bad. I prefer to, I will see myself working until I die. Completely. It's like the work is something that is necessary in your life. Period. That's what it is, you know. But the funny thing here is that uh, you're never, yeah, you're never, you, you'll never own things, it'll be very hard for you to do that. So rich, very rich people, actually, what it does is this Aikido stuff of leasing. Is leasing. Interesting. Okay. Okay. So it's leasing. All right. Okay. Okay. All right. That's part of the game. You know, that's part of the game. Okay. So when I look at read the footnotes, just to make a quick recap of this, is, well, it is packed with significant data, like significant accounting policy and practice, how these companies adhering to certain practice such as the GAAP or the International Financial Reporting Standards, income taxes, which it provide a great detail about local, state, federal, and foreign taxes, pensions, and post-retirement programs, data that is helpful specifically for employees when they want to see how these post-retirement programs are funded, if they are over or underfunded, and the cost of this program, as well as stock-based compensation, right? Which are obligations, or in this case, is the right that the owner have, but not the obligations to buy particular assets at a given upon price and date. And you have two type of options. You have puts and calls, where puts are bet that the stock will fall, whereas the calls are call, whereas calls are bets that the stock will rise. Okay, so this is a type of equity derivatives, which whose undervalued asset lies is on, or the value of this stock options lies in an underlying assets, such as an asset or a group of assets or a benchmark. Okay, so then I look at the written MD&A, which is the management discussion and analysis of financial conditions, uh, uh, and results of operation, where, according to the SEC, is an opportunity for the management of that company to provide insights to investors about important trends that have shaped the company past and reasonably likely shape the company's future. Okay, so here you can see relevant data associated with macroeconomic trends, for examples, or impact that are affecting the business. Again, this is an opportunity uh, to see the company through the eye of management. Okay, and then right now I'm looking at the how you can find this kind of data. For example, the Apple feeling sec, or the sec feelings from Apple. They have that, the Apple sec feelings. All right, on the 10Q, which is this format, you can see that the sec feelings for Apple, or also for Amazon as well. you know, SEC filings, or SEC filings, Form 10Q, or where this 10Q provide you all of this information, uh, not only for the balance sheets, income statements, and cash flow, and also read the footnote, but it packed with the MD&A. Okay, and in today's video, I'm going to focus is on these financial statements, ratios, and calculations that are used for that are used uh, that are used for investors to evaluate a company. So this desirable ratio vary by industry. So if a company has a debt to equity ratio 2 to 1, it means that the company has $2 of debt to every $1 shareholders invested in the company. So in other words, the company is taking on debt at twice the rate than it is owner and invested. So this company is taking twice, again, if the ratio is that, the debt to equity. In Spanish, this is deuda capital, okay, or capital deuda, okay, which means is that how much of this, how much this company is taking in terms of debt, regardless the amount of money the owners are investing. Okay, how much money this company is burning, is getting burned by its debt. So let me now take a look at the debt to equity. Okay, debt to equity here. So after all, debt to equity, okay, is a ratio used to evaluate a company financial leverage, and it is calculated by dividing the company total liabilities by its shareholders' equity. So you have all the liabilities divided by the total amount of shareholders' equity. That makes sense. Okay, debt to equity ratio, and this is okay. If you want to know the ratio of things, when you talk about ratios, ratio meaning, okay, the quantitative relationship between two amounts showing the number of times one's value containing or is containing within the other is ratio, is proportion, is the relationship of this. What is the ratio? What is the proportion? Okay, what is the ratio? What is the relationship of this? Exactly, ratio, relationship, proportion. Okay, so this is debt to equity. Okay, this is a simple formula that is used to evaluate the company financial leverage by dividing the company total liabilities by its shareholders equity. So this, okay, if we take if I keep reading about this, debt to equity ratio is used to evaluate a company financial leverage, and is calculated by dividing a company's total liability by its shareholders equity. Here, so the DI ratio is an important metric in corporate finance. It is a measure of the degree to which company is financing its operation with debt rather than its own resources. Okay, very, very crucial. So, what is the ratio? What is the relationship? What is the proportion, the ratio at which this company is financing its operations through debt rather than its operations? So debt to equity ratio is particularly type of gearing ratios. Gearing ratios, a group of financial metrics that compare shareholders' equity to company debt in various ways to assess the company's amount of leverage and financial stability. I barely understand that. A group of financial metrics that compare shareholders' equity. Okay, it's a group of financial metrics. Okay. Gearing ratios. Gearing. 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 All right, gearing. Okay, okay.
Gearing.
Gearing. Exactly. So gearing ratios, a group of financial metrics that compares shareholders' equity to companies' debt in various ways to assess the company's amount of leverage and financial stability. hmm Okay. Interesting. So what is the gearing ratio? Gearing ratios are financial ratios that compare some of the form of owner equity or capital to debt or funds borrowed by the company. Gearing is a measuring of the entity financial leverage, which demonstrate the degree to which a firm's activities are funded by shareholders versus funds versus creditors funds. Mhm. So this is something very, very important, by the way. This debt to equity, which in its own name says, well, is the ratio at which a company's debt is financing its operations. You can think of that. You can think of this term like that. Okay, is the degree at which a company is financing its operations with debt rather than its own resource. And this is an important metric in corporate finance. Corporate finance because after all, what they offer is administration. Exactly. It's administration. If I want to take a look this English, that deals with source of funding and the capital structure of corporations. Is after all, this is administration. Is administration the action that manager takes to increase the value of the firms to the shareholders, and the tools and analysis used to allocate financial resources. The primary goal of corporate finance is to maximize or increase shareholder value. Correspondingly, corporate finance comprises the three main subdisciplines. Capital budgeting is a concern with the setting of a criteria about which the value. But after all, this corporate finance is about to source of funding and the capital structure. Mhm. So again, so these capital structures or this accounting is something. It is the backbone of the entire civilization or the society. Because if you don't have excellent of research, you wouldn't be able to get to to join or to live together, because we will live in a state of nation. Then with only the strongest survive. So debt to equity. Okay, okay. So that'll be all for this video. Take care. Bye bye.